of business lending and credit risks. So clearly that would be of more interest perhaps to banking students, but it should be of general interest to all of you. So obviously I would encourage you to take advantage of a free lecture from an experienced person in the banking industry, and it's during your reading week, so it doesn't clash apart from students taking Islamic finance. Maybe that's the only clash, but for everybody else there should be no clash with regard to classes. As I say, here it will be in Allen building, and the precise timing we can communicate with you during the next few days. So you will get an email from Beth Ann Hamilton Hine with a bit more detail than what I'm presenting here. Okay. So it's not compulsory, but rather something that would benefit you to hear from someone with 30 years experience in the banking industry, and also in the afternoon taking a look at some case studies where he can lend, in particular, his practical experience. Okay, so it could help you with several modules. This won't be assessed, but your attendance would be recorded, so you could, you would have evidence that you did attend this one-day course. But it's not assessed in any way. Anybody interested?
Yeah.
Yes? Okay, good. Sorry? He's not a tycoon, no. But he has got a lot of experience. Yeah. Okay, so you get an email about that, and most likely it will be on your MyBander timetables as well. Okay. Now, we didn't have a 6 o'clock class last week, but there will be today, obviously. And that class at 6 o'clock will be discussing worksheet 4. So the numbering is now lagging behind by a week. So today is topic 5 and worksheet 4. So the worksheets for today and next Tuesday, they're on Blackboard for you with those questions. And those two worksheets will relate to work we've already done, not to today's work in particular. Okay? So we're moving on to the 5th topic, and we're still building, this is still a continuation of previous topics. It's not a completely new direction, it's still a continuation of what we've done, especially during the last 2 weeks. So let me just quickly recap a couple of points which will motivate this topic 5 based on previous weeks. So from topic 3, for example, this is one of the slides of topic 3, and here we were talking about total risk being having 2 components, as you'll recall, the firm-specific or unsystematic, and then the market risk or systematic risk. So here we've just accepted this risk exists, that we cannot diversify. But today in topic 5 we're going to say a lot more about that. What do we mean really by market risk? And in fact, what might be the sources of that kind of risk? Why do we have systematic risk? How could we explain that a bit more? So topic 5, especially the first half of topic 5, is very much about that. So it connects very strongly with this notion that this average covariance is a positive amount. Here, obviously, average covariance is positive. So at this point, we maybe didn't say too much about why is that. And so the first half of topic 5 is very much connected to that. And then last week towards the end, we didn't spend a lot of time on this, but this was a linking slide from last week, right at the end of last week. with the CAPM, it's a very simple final model. Okay, you might not agree that it's been a simple set of concepts along the way, but what we end up with is a rather simple model. And you may ask the question then, how good is it? Because obviously it's approximating many things from the real world in becoming such a simple end product, if you like, the final model. So here I was alluding last week to the fact that we have quite mixed evidence about how CAPM performs in the real world in different settings. So you'll find quite some difference of opinion about the CAPM. If you ask teachers in finance or academics in finance, some of them will be very supportive of CAPM as a model, others will be supportive of different models. So some of those different models we're going to see today in topic 5. Similarly, if you ask practitioners, whether they're investors or whether they're in corporate finance, some of them will tell you, yes, we like CAPM, we like its principles, and we think it works satisfactorily. Others will tell you, well, it's too simple, it ignores some of the real-world features, and therefore we use something else. So there's mixed opinion. Similarly, if you look at research, there's mixed opinion about the CAPM, and we'll come to that in particular after the break today. In the second half, there will be some points there about the mixed opinion about the validity of using the CAPM compared with some alternative models. So what I try to do in topic 5 then is try to bring together some of these themes and to ask a question as well. If we are not convinced by the model of CAPM, if we think it's too simplified, or if we think we have doubts about its assumptions, then what else will we use? Going back to topic 2, we said we want to know some estimates about the future returns. We need to know estimates about future risk and covariance. So investors need an expected return model of some sort. We can't not have a model of expected returns for many reasons. So if that model of expected returns is not going to be the CAPM, we'll have to find another one. We can't just dismiss the CAPM and say that's the end of the story. If we dismiss the CAPM, we have to find something else instead. Okay? So those are the type of issues that motivate today's topic. It doesn't lend itself so much to the problem-solving type questions that we've seen in the worksheets. So you see many more problem-solving type questions in the past exams based on topic 3 and 4 rather than this topic. So this topic in the assessment, in the exam, will be connected in some way to topic 4, or maybe connected in some way to topic 6. So you can see that in terms of how it's assessed on the past exam papers. So this is the outline for today's session. Factor models, we talk in general what do we mean by factor models. But briefly, that means we're going to use model of expected returns, still expected returns that we're interested in. And we're trying to find some factors that will explain expected returns. So in the CAPM, what is explaining the expected returns? So look at the expected return in the CAPM. What are we using to explain it? Beta, yeah. So beta is a major component, which is reflecting the sensitivity to systematic risk. That's the major factor, if you like. And beta is multiplied by what? Risk premium, thank you. Okay, so that means the extra return on the market compared with the risk-free rate of return. So the two crucial things that we consider CAPM are the market or market portfolio, more specifically expected return of the market, and then beta attached to that as the sensitivity to the market return. So in factor models, we're going to consider other types of factors beyond the market portfolio. So again, it's not a departure from CAPM, it's a continuation of what we've done last week and the previous week. So selecting those factors will be, this is the question really. We've talked a lot about covariance, but now we're going to ask a deeper question. Not asking what is the covariance, but what causes the covariance. What causes the covariance is what we're at least in the first half today. And the answers primarily will come in those two categories, macroeconomic variables or firm characteristics. And then these so-called factor models will tend to draw either macroeconomic factors or firm level factors. So give me some examples then of a macroeconomic variable model.
Later.
Okay, so the discount rate or interest rate, inflation I've heard. Bond return or bond yield, that's correct, yes. Somebody's said GDP, yeah. So some measure of the size of the economy, GDP, or change in GDP, growth rate or decline, if you like, in other cases. Exchange rate, very good, yeah. What do you want to do after you finish your master's degree? Employment. So unemployment is hopefully not something you'll be thinking about. Okay? That's why you're here, to get better employment. So unemployment is a macroeconomic variable, obviously. Okay, so we've got bond yields and interest rates, and some parts that will be connected with credit. Okay, credit or credit risk on an economic level rather than individual firm level. We've got the size of the economy, GDP or GNP, we've got inflation, we've got unemployment, we've got exchange rates. Okay, so those are the type of variables that might be on the list of what we might call the candidate variables. So firm characteristics then, how might we conceive of some firm characteristics? Now, just before I ask you for the answer, be careful here. I'm talking about the characteristics of a firm. It's not firm-specific risk. That's not what we're talking about. Okay? So the previous 2 weeks we've spoken about firm-specific risk. That's unsystematic risk. Here, these factors are only about systematic risk. So it's only about systematic risk. It's still thinking of a situation where it's a diversified portfolio. So it's firm characteristics, not firm-specific risk. So what kind of characteristics then might it be? The size of a firm, yes. So that will be very variable. How would we measure the size of the firm? Capital, okay, capital, working capital, market capitalization. So, book value, employees, market share, okay. Many candidates you could think of as the size of the company. One is from the stock market. Yeah. So the stock market capitalization. How do we calculate the capitalization of the stock market? Well, yes, it could be historic price, but the share price, yes. But share price multiplied by what? Number of shares, okay? So when we say stock market capitalization, that's the share price times the number of shares. So that's a market value. Market value because the share price can move around dictated by the market. The other ones that mostly you've mentioned, where do we find those numbers for employees or what else? Book value, you suggested, where we're going to find the numbers. Financial statements, okay? So, stock market capitalization is a stock market measure, if you like, because it's based on the share price. And many of these others you've spoken about are going to be in the balance sheet, mainly, of the financial statements. One or two of your suggestions might be in the profit and loss statement, but mostly the balance sheet variables, the others that you mentioned. Okay, that was a long discussion about one variable, which is just the size of the firm. What else might characterize the firm? Firm's credit risk, yes, potentially, yes, that's a variable. They're not all the same credit risk, that's fair enough, yeah. Environment, possibly, yeah. Why I'm pausing is that's quite difficult to quantify, perhaps, yeah. And these kind of models will like variables which are relatively easy to quantify and not subjective, maybe more objective if possible. Okay, the firm's characteristic relative to the economy in some way is a good suggestion, yes. So in some cases you might find the assets divided by GDP or something like that, yes. So that's useful contribution. But what else can we find in the balance sheet? Or what else can we find in the profit and loss account? Profitability, yes. Dividends, thank you, dividends. We're going to talk about dividends as one firm characteristic later, right at the end of this topic. You mentioned book value. So what we're going to do with the book value, compare the book value to the market value. That's two valuations which are not usually the same. Okay? So the ratio of book value to market value, or the inverse if you want to. Okay, so those are some of the suggestions that we'll see later, and there will be other ones as well. Then we come to how would we use macroeconomic variables? Well, primarily they would fit in with this approach, the so-called arbitrage pricing theory. And more commonly, the firm characteristics would fit into this kind of more empirical approach. Okay? So we can make a comparison here. As you know from the last 2 weeks, there's quite a bit of theory which underlies the CAPM. Similarly, there's quite a bit of theory behind the arbitrage pricing theory, APT. But those two, CAPM and APT, are somewhat in contrast to these, which are more empirical. So what does the word mean, empirical? Well, yes, something from practice rather than theory. Empirical evidence, what does that mean? Evidence from practice. Could be case study evidence. From experience in some way, yeah. From the past financial statements. From the past stock market performance or share price movements. So empirical in general is taking evidence from practice, and sometimes is motivated by theory, but sometimes is not. So in the case of this aspect here, we have to say really these have got much, much less theoretical basis compared to APT or the one we've looked at in detail, CAPM. So there's a contrast between theoretical basis and a more empirical basis as well that will fall into our discussion. Okay, so let's move on to some more detail on all of this. But remember, in case I haven't made it clear enough, we're talking about systematic risk. Okay, we've got already diversification. We're still only talking about the systematic risk in these models. We are still assuming we follow all the principles of topic 3 with diversifying. What we're doing is seeking to explain systematic risk, perhaps in more detail than we did with CAPM. Systematic still is not the total risk. So beginning with the general thoughts about the factor models. So as we said, we're thinking about some factors that will influence the systematic risk or the sensitivity to the systematic risk when we want to model or explain expected returns on assets and portfolios. So we might have some common factors, as they're called, which might be capturing or proxying, approximating or capturing events in the real economy. So those are the macroeconomic variables that we've been discussing. Or they could be drawn more from the firm level. That's not to say they're firm-specific risk, but rather that they are characteristics of firms which are influencing the systematic risk still. Okay? We've established this point already, so we still have this point, and what we're looking for is how these common factors can explain the systematic risk. So we already got rid of the unsystematic or firm-specific risk in the ways that we've addressed in the last 2 weeks. So we have a lot of similarity with what we already did, and a lot of similarity in terms of the approach that we saw in the CAPM. So in both cases, the CAPM and the factor models, the unsystematic risk is diversified away, and we're left with only systematic risk that we need to concern ourselves with. We could think of a CAPM as being just a one-factor model. In other words, it could fall into this category of factor models, but it's a one-factor model. And you already mentioned what that was, which is a market portfolio, or the expected return of the market portfolio is the one factor to which we attach beta, the sensitivity to the market return. The difference here is it's likely to be more than one factor, not one factor. So whereas CAPM has the one factor, these models typically will have more than one factor. If they have more than one factor, they'll have more than one beta. So the interpretation of the beta is still similar. Each beta will be measuring sensitivity to that factor that influences the expected returns. But now we are likely to have more than one beta. And then we choose. So herein comes something quite different. Obviously, CAPM gives us what you might call closed solution. The model is the model, as we wrote it down. Expected return of the portfolio is risk-free rate plus beta times the risk premium. That is it. Whereas here, you have much more user input, if you like. There is not one model written down the same way as the CAPM. So that makes it more challenging for you to conceive of it in some cases. Also, you'll find a lot of different suggested models. So clearly we're only going to look at some examples. We can't go through the whole variety of models that are being proposed, still within this umbrella, if you like, of factor models as a general term for it. Not only will they have different factors, they may have different numbers of factors. 2-factor model, 3-factor model, 4-factor model, 5-factor model. So we'll come back to that, especially in the second half, discussing different numbers of factors that might be included. So you're going to find that these are including some models, macroeconomic factors or firm level factors, motivated by the designer of the model, if you like. It's not a concrete selection in the same way as CAPM is a very specific equation that we can write down. So we're going to look at two cases where we can draw the factors. First one is the macroeconomic variables. Second one is obviously the firm characteristics. Here we're going to link the macroeconomic variables with the arbitrage pricing theory, and then we'll link the firm characteristics with the more empirical models in the second half of today's class. So we've already spoken what kind of variables might they be. Here is a much more detailed example of what the variables might be here. So this article is a very widely quoted, General and Ross, from many years ago now, but quite influential on subsequent authors. So what did they choose? So they're looking for unexpected changes. We've spoken in previous worksheet number 3 about risks. We wanted to classify them as unsystematic or systematic. And a lot of them were based on surprises or unexpected news. So here, General and Ross do something similar. They're capturing these variables based on surprise component. So this is very explicit here. Unexpected inflation. Some of you suggested inflation could be one of the variables we might choose. Much more specific, here we're saying the unexpected inflation is what's causing the systematic risk, not just inflation, but the actual minus the expected. Okay? So that's a relatively simple variable, but it captures the idea that it's the unexpected changes that will drive the risk, not what we already expected to happen. Okay. Others they've chosen here, change in GDP growth rate. Well, we already mentioned GDP and GDP growth as potential candidates on our list. Here they're saying that's capturing what might affect earnings. So if the economy is growing, investors and others will expect companies' earnings to improve and vice versa. We mentioned the credit markets, and actually we've got 3 here which you might say are attached to the credit markets. Yield curve, credit bond yield spread, and short-term government bonds. So again here, expectation, changes in expected inflation. So in general, that's what you would find is those types of macroeconomic variable being used in a factor model, where they're motivating these as influencing systematic risk, in other words, risk affecting all investments or portfolios potentially. So a couple of these I need to maybe explain a little bit more, especially the second one. So change in the AAA to BAA bond yield spread. So I'm saying this is something to do with default risk, credit risk. Credit risk was suggested as a firm-specific variable earlier, a firm characteristic. Here it's capturing an economy-wide type of variable. So what is a AAA and BAA? What does it refer to? Credit rating. So what is AAA? Top or bottom? Top. So top, AAA is the top of a credit rating scale. So will such a company have a high borrowing cost or low borrowing cost? Lower. Yeah. So higher rating, lower borrowing cost, crudely speaking. Yeah. So what is BAA then? Is that high or bottom or middle? Middle. Okay, middle, but still classed as good, not bad. Yeah. So upper middle, you might even call it upper middle, BAA. So BAA type companies, would they have high borrowing cost, low borrowing cost, middle? Yeah, middle. So we're comparing the top of credit quality with the middle range of credit quality here. And why? Let's say, the AAA is facing a yield, which is a proxy for the borrowing cost. Let's say that's 5%, and the BAA is 9%. So that's what we mean then by spread meaning the difference there. So let's say the top of the scale is paying 5% bond yield and the middle is paying 9%. So what this is saying is that's not constant. Okay, that's not constant. In good times, this will get smaller, the difference, because even the BAAs are very unlikely to default. If it's good times, economic boom, whereas in bad times or recession, the AAAs will say very, very unlikely to default, but the BAAs would quickly deteriorate in quality. So in different times in the economic cycle, this spread will change, and more specifically, there will be a bigger gap if the bond market expects worsening economic conditions. If they expect worsening economic conditions, they will be requiring a higher premium, in other words, a higher return, or in other language would be charging a higher borrowing cost to these middle-ranking companies. So that's why this is capturing a risk premium. So capturing the change in credit risk across the economic cycle of expansion and contraction. And then the yield curve. What is the yield curve based on? Government bonds, thank you. Yeah, government bonds. So yield, why is there a curve? It's because it captures different maturities of the government bonds. So some government bonds will be maturing in 1 month, bills will be maturing in 1 month, others may have a 30-year maturity. So they will have different yields. Sometimes it will be flat, although that's very unusual. Other times upward sloping, and other times downward sloping. So without going into too much detail, the slope of the yield curve is looking at the future expected discount or interest rates. So what's expected in the future in terms of interest rate movements. That's the interpretation, that's all we need really to take from this line. Okay, so it's obviously not as simple as just to say what is GDP, what is inflation, what is unemployment. Clearly you have to specify it a bit more carefully than that to capture the risk components. And this is a good illustration of what I mean by capturing a bit more precisely the unexpected aspect of the surprises or the changes. So how many factors here then? 5. Okay, 5 factor. So this would be a model with 5 factors in this case. So very different from CAPM, which only draws on 1 factor, the market portfolio's return. Okay? Every time you see change, that's 4, and unexpected is the 5th. So there's a small diversion here, which is, here I've used citation. In other words, I've mentioned some source of information. A citation to Chen, Roll and Ross. So if this was in your essays, you would mention a particular paper in that way with the author's surnames and the year it was published. And we'll see in a moment I have a reference list when we see the other details about Chen, Roll and Ross. Okay, so it's the unexpected changes in the macroeconomic conditions, according to this point of view, which drive the returns on assets and portfolios, and therefore these are capturing the systematic risk. Another way to express that is these are the reasons for positive covariances. These are reasons for positive covariances. In other words, these could be reasons why different stocks' returns are going up at the same time, why different stocks' returns are going down at the same time. So they're positively covariant, not negatively covariant, and that's why we have the limit to diversification. So that's another interpretation. These are driving positive covariance. So, clear advantage of that, I would say, even compared to CAPM, is there's more intuitive meaning there. CAPM just says everything's based on the market portfolio, whatever that is. And here we've got a bit more intuition, okay, expected inflation, changes in interest rates, these are driving the risks, these are causing positive covariance, there's more intuition there of those connections between these variables which are chosen to positive covariance to systematic risk. Okay. The disadvantage is, I haven't written down any model because this is not a unique model. This is just these authors have come up with this as their recommended model, if you like. So it has a strong subjective component in that sense. They have decided the choice of these 5 variables. Also, some of these, like earning expectations, Chen, Roll and Ross measure it one way, other people might measure it another way. Another issue is, you mentioned environment, that was related to firms, but here, environment might include political situation. So you might consider, obviously, many flashpoints around the world at the moment, or you might think about Arab Spring, for example. It would be hard to argue that anything is more important than the political stability affecting those portfolio returns at that time. But how do you measure, how do you put a number on it? How do you put a number on political risk or political stability? Not quite the same as putting a number on inflation or employment. And then the frequency of the data, you could think of Western European countries, and you've got very long-established statistical agencies and so on. But that's not true all around the world, is it? Some countries might not publish monthly data, they might not publish quarterly data even. So you may only have annual data, and that data may not even be particularly reliable. So a number of issues in practice encounter some disadvantages, shall we call it, of this approach. So the alternative might be to use the firm level characteristics. So if you have listed stock of the firms, if you have financial statements and if you're confident with the accounting principles in the financial statements, then maybe you could overcome some of those problems I just mentioned, like data frequency or political measures and so on. So some of these potential variables we spoke about, size, obviously we discussed many ways you could measure size of a firm. The book to market value we mentioned, so the ratio of the balance sheet value compared to the stock market value, essentially. Somebody mentioned dividends, so that's there. Leverage. What is the leverage of the firm? How do we look at the leverage? How indebted are they, or what's the ratio of debt to equity in the firm's balance sheet? Yes, so leverage. And we use the term levered portfolio and unlevered portfolio in previous weeks. So unlevered was without lending and borrowing, levered was with lending and borrowing. So the debt of a firm could be a factor, or debt to equity ratio. So industry, that's fairly self-explanatory. But what about momentum? Anybody know what the momentum factor would be? Acceleration, well, change over time, yes. Change over time means stock return, in fact. So momentum means positive returns following positive returns, or negative returns following negative returns. So this has been very heavily studied in the last few years in the asset pricing area, because there's plenty of documented evidence that, you know, if the stock return of a firm is doing well in one period, it tends to follow momentum. In other words, continues to do well in subsequent periods. Or alternatively, negative returns follow negative returns. So momentum means it carries on in the same direction, whether positive or negative. Okay, again we have some advantage of intuition. We could understand something from the dividend or the leverage, which would be connected to the risk, and similarly the other factors. But again, we have a choice. You know, for example, and then a list of 6. Well, how can we justify which of these? There's no one model written down that everybody says you should use. Although we will see a couple of examples in the second half of this talk. Again, can we think the past is a guide to the future? We want to model expected returns. We're not trying to explain the past here, we're trying to model the expected returns in the future. Now, a lot of this topic is directed to whether we can rely on the CAPM, and one critique is centered around the market portfolio. And as I said last week, the market portfolio in theory is every risky asset. Every risky asset would be included. So that's not practical. So we have to have some approximation, proxy, as I've said here. And this critique of the CAPM says we can't even test it. We can't even test it if we don't have what they might call a true market portfolio. So the difference with the factor models is arguably they are testable. They are much more clearly testable than the CAPM. So the arbitrage pricing theory has a developed theory behind it. I'm not going to delve into all of that today. All I want you to consider is it's similar to the CAPM in the sense that it is drawn from a strong theoretical ground. Okay? It's not starting only from evidence or empirics. It's drawn from a strong theoretical basis. And that will contrast obviously with the empirical models later. So typically here it's connecting closely to the discussion we just had, like Chen, Roll and Ross would be a version of this arbitrage pricing theory where you have a number of macroeconomic variables in a factor model and you have sensitivities to those different factors. So unlike CAPM, it's not the case that we have a market portfolio. So that's the bit which is sidestepped, and that's why we have this slide here. You know, the market portfolio is central, obviously, in CAPM, whereas in APT or these other models that we looked at, the market portfolio is not the only or the central consideration. But we still remember focusing on systematic risk, not the total risk. So finally, we can try and write down how we might represent such a factor model in general, but also within the APT or arbitrage pricing theory approach. So we do have something similar to the SNL of last week, or security market line, except it's now multi-dimensional. Security market line, we just have return plotted against risk, and we have one factor, the market portfolio, and we have beta. Here we've got more than one beta, and therefore the diagram is not in those two dimensions, but many more dimensions potentially. So to write it down starts off very familiar. Expected return of asset I or the portfolio equals the risk-free rate, RF, again the risk-free rate. And then the next term looks familiar, but it's not M, it's not RM, it's not the market portfolio, it's the return that we can attribute to some of the factors like unexpected inflation or change in slope of the yield curve, those factors that we saw on the list just earlier. And then we don't have a close to the equation. Effectively, we've got dot, 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 meaning it might be 3 factors, it might be 4 factors, it might be any number of factors. So this general expression just ends with n, the nth factor, which might be 2, might be 3, might be 5, and so on. Now the betas here, they have a very similar interpretation as we do in CAPM beta. Covariance standardized by the variance. But it's not n, it's not the market portfolio, but rather the variance of returns attributable to one of these factors in each case, like unexpected inflation, like the change in GDP growth that we saw on the list. So we still cannot be more precise than this. Obviously, in Chen, Roll and Ross, we would write it down as 5 factors that we had on the list on the previous slide. But still, that's not, definitive. There's still questions about how many factors and what they will be. I suppose another way to express that is to say, well, we can test this now because we don't have a market portfolio, which is something very difficult to measure. We only have a proxy. Yes, we can measure inflation. Yes, we can measure GDP. Yes, we can measure interest rates. So now we can test this model, and therefore we can test did we make a good selection of factors. So although we don't have precise answers how many or what factors, if we do make choices, we can then test it. How good was that choice? How good was the number of variables we selected? So we still have many of the ideas of the SNL here. Nothing is very different than our discussion of SNL last week, except it's all happening in more than one dimension, multiple factors. So this SNL, not one SNL, but many SNLs. Linking to those betas that we just saw in the equation. We still talk about mispricing in the way that we did with SML. And the title, arbitrage pricing, comes from that aspect that we did touch on last week, that if there's a mispricing relative to one of these factors, then investors will buy or sell to correct what they perceive to be a mispricing. So a lot of it is very much consistent with what we've discussed before about the SML, in particular how arbitrage would be the force which corrects any mispricing. So here we've got something very similar to last week, and we will be thinking about this in a few minutes. So we've got expected return again, and we've got a beta measure on the x-axis, but this is not a CAPM beta now. This is one of these betas here, so it's not sensitivity to the market. It could be sensitivity to inflation, sensitivity to interest rates, sensitivity to credit risk premium. Okay? So it's still labeled as beta, but it's not beta relative to the market portfolio the way it was in CAPM. But the arbitrage pricing theory is still saying that we have this equilibrium for every factor. Okay? So ignore the dotted line for a moment. First, we could think of B and A in a similar way that we did last week. Though this is not the CAPM's SML, it's an SML within ADT, which would be repeated in more than one dimension. So B, this is equilibrium, so B has a higher expected return. So let me just say, compared to the inflation risk. Let's just pick one, inflation risk. So is it attractive to have that or not? Yes. So why is B attractive? Higher expected return than what we expect for exposure to inflation, shall we say in this case. A is below the equilibrium. Do we want it or not want it? We don't want it. Similar argument to last week. Okay, so we could follow our arguments of last week. The expected return is too high, so it's underpriced. Everybody buys it, the price will increase, the expected return will fall. A, below the line, A is overpriced, expected return is too low because the price is too high, so the price has to change for expected return to increase. So last week we spoke about them as separate cases, perhaps. So what's the problem if we just say, okay, we can observe B, and gives us a very good return compared to our inflation risk, let's say. But what's the problem with just buying B? Yes, there will be a change, there will be a response, that's what we expect. But if we hold B only, let's say, if we buy B, how much risk are we taking? Positive risk or no risk? Positive risk. Beta is not zero at the point B, so if you buy B because it's underpriced, you don't have zero risk, and this is the beta level here. So what you can do is buy B and then offset it. For example, here we've got another mispriced A, so we could sell A as well. Okay. And that's where the dotted line comes in here, is if we do both. So if we buy and sell more than one mispriced asset. So think back to this equation of last week. portfolio betas, and you use this in question 2 this evening. Okay. So what we're saying is we buy B, that would be a positive weight here. If we sell A, that would be a negative weight of X. Okay. So once we have one positive weight and one negative weight, we can manage to bring beta to 0. Yeah? So once we have a positive, for one case, buy B, sell A is a negative sign, you can engineer beta to be 0. So this is, let's say, for example, beta 0.6, and let's say this is beta 1.2. So let's keep it simple by saying one is double the other one. So then you would put an equal amount into the two legs or the two parts of your arbitrage. You would put twice as much in the low beta to match up with the amount you've got in the high beta. In this case, if it's 0.6 and 1.2. Where would you be on the diagram if you did that? Where would you be on the diagram if you assumed beta of 0.6 for B and beta 1.2 for A, and you put twice as much into B so that you can balance those betas? Where does that leave you on the dotted line? What are we trying to do in the arbitrage? We don't like the fact that if we buy B, we've got a positive beta, and beta would we like to arrive at 0. So that's where we're going to be on the graph. So if you do both arbitrage legs, if you like, both legs, what you're trying to do is to be here. So the argument is if we just buy B, we have this much beta. So if we balance these two in the right proportion, we can be here. So, like we've seen before, a straight line is making up of different portfolios, and there's one portfolio made up of B and A, which could be here. So this would then be 0 beta and a much higher return than the risk-free rate. So that's a very strong arbitrage of profit, we would say. So it's a risk-free portfolio has been created, and that will exploit mispricing not just of B, but also of A as well. So this is what's going on according to the arbitrage pricing theory in many dimensions. These arbitrage opportunities, if they arise, will be corrected by that force of supply and demand, buying of B, pushing down B back to the equilibrium, and similarly the reverse case, pushing A back to the equilibrium. So it's very, very similar to the SML. I've only done two things extra here, which is to say it's going on in multiple factors and not just about the market portfolio. And the only other thing I've added is, of course, thinking about getting here rather than just talking about buying or selling. The more sophisticated is trying to be here with a 0 beta arbitrage. So long position means buying, short position means selling, and then this is the force of arbitrage that we expect, that the prices change according to the force of that arbitrage. If you have such a position as this, which is possible to create, who wants to be there? How many investors want to be there? All of them want to be here. So it's a powerful force if everybody wants to be here, such that these will correct quickly. That is the argument central part of the APT. You know, anyone who can find a place on this place in a portfolio on the y-axis with good return and no risk, everybody will be searching for that. So this is a position we want to try to find, and do that by choosing values of x in that formula for the portfolio beta, and then this is a strong force for bringing these mispriced securities back into line, literally into line, into the equilibrium line. So that is going on in CAPM as well, but this is going on in all dimensions of the APT, or all factors in the factor model. Okay, so that's summary and conscious of break time. So if we compare that, since I said there are similarities with CAPM, CAPM just says there are positive covariances. Now APT wants to explain them. In other words, what causes the positive covariance rather than just saying it exists, and attributes mainly those causes to macroeconomic sources in the predominant APT applications. CAPM is only focused on the market portfolio, nothing else, whereas APT and other factor models have many factors, but the beta still has a similar interpretation. It still can be defined as a covariance divided by the variance of that factor, as we saw. So again, some similarities, but we could say the APT is maybe one step more sophisticated for these kind of reasons. Okay, now referencing. I mentioned these two, so I've cited Chen, Rowe and Ross in my slides, I've cited Rowe in my slides, and therefore my reference list gives all the details. Okay, I know many of you know about this already, but we're just building this in here just to emphasize the kind of citation and referencing we would expect to see. Now, I didn't write down the name of Ross, but Ross is the originator or starting of this arbitrage theory of price. So these are not here for you to read them, although I wouldn't discourage anyone from reading them. It's not the expectation you read them. This was just an illustration of referencing, in fact. Okay, it's high time for the break now, and we will return with the empirical models after the break. Okay. So this section may be a bit more accessible in the sense that it's now going to focus on empirical models rather than a quite theoretical set of ideas we had before. So in arbitrage pricing theory, I'm connected with macroeconomic variables as the factors mainly. So here now I'm going to connect the empirical type of approach of explaining expected returns with firm level of characteristics. So we looked at APT, connected it with macroeconomic variables. Now we're looking at empirical approaches connected with firm characteristics, firm level attributes, you might say. So we're still talking about the systematic risk, remember, and sensitivity to the systematic risk. So we'll be looking at variables like size and dividend yield. We're going to look at two different models which have slightly different approaches as well. Farman French model, which is very famous, and one dividend yield model where we take a slightly different approach to the question. And then this is making a note here. These models, which are empirical, they tend to be based on observed attributes or data from the real world, as it were. They're not following some theoretical motivation around in the same way as APT and CAPM. So maybe some of these authors of these models might say they've got some theoretical reasoning, but it's nothing like the theoretical basis that you see in the CAPM or in the arbitrage pricing theory. So the first one we're going to look at is probably the most famous, well, definitely the most famous of these, or this group of pricing models, which is to say the Farman-French model. So this is drawing from stock-related variables of firm characteristics, and it's the most popular of its type, as I say, and it's so-called also a three-factor model. So it's a factor model, and it's got three factors, obviously, hence it's labeled three-factor model. So Farman-French, they are American academics, Eugene Farman, Kenneth French, and Farman. We'll hear about again next week. This research comes from the early and mid-1990s, whereas next week we'll talk about his research from the 1970s. So, very famous researcher in finance. Now I mentioned here, if you're following an empirical approach, you need to avoid so-called data snooping. So what do I mean by that? Well, in the CAPM, we started from lots of concepts, principles, and theory. In the APT, you start from a lot of concepts, principles, and theory. Although we didn't go to the same detail as we've done with the CAPM, that's still there in the arbitrage pricing theory. With an empirical approach, you don't start there. There's a tendency to start with the real-world observation. Yeah. So you're not starting with a theory, you're starting with some real-world data observations, and very often it's afterwards that you look at how you explain that theoretically. So it's somewhat the other way around. Now, the danger of that, doing it the other way around, is you can find some nonsense relationships in the data. You can find what we call spurious relationships. They don't have an intuitive meaning, or you cannot explain them rationally because it's just driven by the data. That's a danger. And related to that, you might have a model which you might say is overfitted. Overfitted meaning, or one meaning would be, it fits very well to the past, but is absolutely useless in the future. Yeah? So the trouble with that is we are looking at expected returns. It's the future that we're interested in, not the past in particular. Or if there's any relationship in the past, we're only interested in if it will continue into the future. So there is that risk of either snooping the data, searching for relationships, or having a model that might have worked well in the past but not in the future. So here, it's a three-factor model. We can actually write it down, whereas previously we've written the factor model in a very general way in the first half, although we did specify 5 variables that Chen, Roll, and Ross chose. Here we've got 3 variables that Farman-French chose in the first case in 1992, and then subsequently they tested it many times in different ways and different settings. So this starts off very much like the characteristic line that we had last week. The characteristic line was the third line we discussed, and we spent relatively little time on it. But this was the characteristic line last week, right towards the end of last week. So on the left-hand side, you've got excess returns. Excess returns because risk-free rate has been moved over to the left compared with the SML equation. So this Farmer French model is starting like this, excess returns, and similarly our dividend yield model will also start in a similar fashion. So RIT minus RFT, so we now have T subscript for time, so that means we're going to look at a time series of data on which these betas would be fitted in a similar way that I just discussed the characteristic line towards the end last week. So now we have an alpha, so that's an intercept, and then we have beta 1, which is cap n type beta, because we are keeping here the market index as a proxy of the market portfolio. So they didn't throw away that part of the cap n here, they kept it while adding 2 more variables or 2 more factors. Okay, so we've still got the market portfolio or the market index. Then we have SMB, so small minus big. So what they capture with that factor is differences in the returns of small companies versus returns of portfolio big companies. So we spoke about size earlier, and this would be size measured by market capitalization. So the idea here is based on a historical, empirical observation, small companies, higher returns than big companies. That's where it comes from, an empirical fact or an empirical observation historically. Then we have HML, high minus low now in the ratio of book value to market value. As we mentioned before, book to market is the short phrase for it, book to market. So book value from when? Balance sheet, yeah. So book meaning the accounting statements or financial statements. Market value, stock market valuation of the firm. So here we're considering that firms with high ratio of this book to market have different returns to those with a low ratio of book to market value. So this could be indicative of many things, but it could be indicative of over or undervaluation market relative to the accounting valuation. So in their model, in the first instance in 1992, they look at US companies and stocks for the time period stated there, and the beta of cap n doesn't do a good job. So in other words, this beta 1 that I've got here doesn't do a very good job of explaining the returns or the excess returns on the left-hand side, whereas beta 2 or SMB, beta 3 or HML do significantly explain the stock returns over that time period. So in other words, those factors that they constructed do explain the expected returns. So explanatory power, meaning these factors that are being proposed here in this model do explain the expected returns. So explanatory power. So higher returns are found in the small stock portfolios and in the portfolios which have got stocks with high ratio of book to market value. Okay. So high B to M, well, that could be high because N is low, for instance. Yeah. So we could consider why is N low? Why is the market value low? Could be a company in distress, for example. The market price is devalued because it's in some kind of financial distress. So that makes it a more risky company than those with lower ratios. So here in the second bullet point, that's what I was just discussing. And then there may be an argument that small stocks are more sensitive to macroeconomic or business conditions. So this portfolio SNB may be picking up macroeconomic conditions or business conditions in a very concise way in one factor, all of the business conditions or macroeconomic conditions. So, two things you might draw from that. One is you might say, well, this is justifying those factors after the event rather than starting from a theory about it. So that's one criticism that people would make compared to APT, for example. Another thing you might say, is it special to certain time periods or is it special to certain countries? So again, you could ask whether there are criticisms that might be made there about the choice of these factors. And there is a debate around such questions. So again, kappa and beta is there, although they say in their first paper it didn't explain very much, it does explain some portion of the systematic risk. So again, bear in mind what we're trying to capture is reasons for positive covariances, effectively. So if these proxies, SNB and HML, capture macroeconomic conditions or the riskiness of business conditions, then they are contributing to explain the positive covariances among the different stocks and hence systematic risk factors. So I mentioned sensitivity. For a different time period, they find that the beta of kappa works well. So for an earlier time period, again, you might ask why that time period, but you find a good, positive, significant relationship between the returns and the beta here, meaning kappa and beta. So in other words, in a different time period, the beta 1 is significant and explains that variable of the market index explains a lot of the returns. So, there's a lot of issues here which imply, like before, certain model might be time specific, or it might be very difficult to generalize the same model or equation in all settings, meaning all countries and all time periods. It's very difficult to claim that. Now, in the research world, somebody publishes something new, like they did here in 1992, inevitably there'll be questioned and people will try to unpick their model about whether it's really true or not. So here's another example which you would find other authors trying to criticize the quality of the data they use. So these are kind of issues that are relevant here, but they're also more generally relevant to you. For example, when you're writing an assignment, that's the sort of thing we are very happy to see from a master student, is some kind of criticism of some article that you're reading. Maybe an assignment from me, maybe in your dissertation, maybe in other assessed work. That's the kind of thing we'd be very happy to see if you think about some weakness in some article that you're reading. So, to be more specific, if you're doing the essay, assessed essay for this module, yes, I've asked you to read some articles, to have a minimum of 10 references, but if you can not just review what has been done in those papers, if you can go a little bit further and say, well, I can see some weakness in this paper because of their data or something they've forgotten or omitted in their discussion, then at the master's level you're going to get rewarded with extra marks for those kind of thoughts or critique. Clearly many of the January students know that already, but this is a case where other authors were looking at the data that Palmer and French used and coming to some specific questioning of their results based on the data. Sorry. Yes. So I'll repeat the question, stretch over. So the question is, what about companies that are not listed, listed on the stock market? Clearly these variables that are chosen here, which are size measured by the market value or the equity market value, and book value to the market value. Obviously, both of them are very dependent on being able to observe market value. So they are designed much more with listed companies in mind, most definitely. Yeah. But you should also bear in mind that these are factors that are seeking to capture risk. So one could argue that the factor is still relevant to explain risk of unlisted companies as well. Yes, you will have a more challenging practical implementation because you don't have those listed stocks valuations. But nonetheless, you can still use these factors as capturing systematic risk. So a very good question indeed, and it is much easier to conceive of this for listed companies. But SMB, HML, these are risk factors. They're not to be taken too literally about book to market, for example. It's a way to capture the risk factor. Okay, so I say there's some questions there, and that is highly typical of this topic that we've got today. Difference of opinion, and that's something you would come across quite a lot at Masters level. We don't have precise answers for explaining the real world. People have different opinions about the best model, or how you should approach the model. So there is a debate which probably never ends about what's the right way to specify such models and so on. Now, following on from Farmer and French, a few years later, we then see four-factor model. Four-factor model follows this and adds momentum factor we mentioned earlier. Momentum factor. Now, very recently, Farmer and French have five-factor model. So this is typical that it's not a static situation when we discuss these pricing models. There's a development over time, and that's what many researchers are looking for. Of course, nobody can explain the future. We're still trying to do the best job we can of explaining the returns we might face in the future. So, in many applications, this Farmer and French three-factor model, nonetheless, has been very widely used in the last 20, 25 years. From 25 to 20. So, in chapter 13 of the main textbook, you can see more examples of applications of this model there. So we come to the last section, and here we have another model which is drawn from firm characteristics, and this time it's the dividend. And in many cases it's been shown that the dividend yield captures a similar kind of risk as this book-to-market ratio. So in many cases people have shown a high correlation between the book-to-market ratio and the dividend yield. In the UK, in particular, evidence for that. So, if there's correlation, what you might say is that they're potentially capturing some underlying feature, some underlying risk, which is, after all, what we're trying to do in selecting these kind of factors. So they may be correlated because they capture some of the similar risk which is underlying these firms and their stocks. calculate the dividend yield then. We've spoken about the dividend before, we included dividend in numerical examples with arithmetic return and so on. So what's different about the dividend yield compared to the dividend? So yield is okay, so you take in the dividend and you divide it by the price. Okay, so it could be commonly that you add up all the dividends for the year and then you divide by the price at the end of the year, sometimes the price at the beginning of the year. But it's scaled, in other words, the amount of dividends is scaled. So some people call it E over P, dividend over price, E over P, dividend yield. Dividend yield varies a lot around the world in terms of what percentage it might be. Countries like the UK could be quite high percent, and many other countries where dividends are much less popular, much less used. Now, high dividend yield portfolios tend to have higher returns even after controlling for kappa and beta. So that's a statement coming from a lot of empirical evidence in the real world. There's a lot of evidence showing you pick stocks because they've got high dividend yield, create your portfolio, and it will have higher returns than predicted by kappa. So it outperforms on the basis of kappa measuring risk. So some people show that to be economically significant, meaning you can genuinely make higher profits or higher returns that way. Other people will say, maybe, but you might face higher taxes in this kind of portfolio. Because dividend is income, and income tax can be high for many investors. So nonetheless, it's a very long established idea that higher dividend yield is attached to higher returns, higher total returns. So here we have another model which is asking a slightly different question than previously. This is the characteristic line again, characteristic line. So we're taking excess returns on the left, and we're taking kappa and beta on the right. So we're not here putting the dividend in the model. Instead of that, we are creating portfolios based on the dividend. So the RP is being created by ranking according to the dividend. So you create a portfolio of the highest dividend yield, split into how many portfolios you wish, but here it's into quintiles, in other words, rank top 20%, 20 to 40, 40 to 60, and so on, and then finally companies that don't pay any dividend, so zero dividend. So this is a test of the kappa, effectively, of whether the dividend is missing from the kappa. So it's asking the question slightly differently, obviously still on the same theme that we've had. So how would we know if the dividend gives us more information is mainly through this alpha. So the alpha is going to pick up any extra return that comes from that particular portfolio. As I say, it's going to be ranked portfolios according to dividend yield. Or indeed, alpha could be negative, which is to say it's less return than predicted by the kappa. And this is a regression, so for completeness, we've got this U. U is the error term, right? So there's an error term at the end. So students who have done research methods should be familiar with that kind of specification. Others doing research methods now, have you come to regression yet? Not yet. So when you've gone further in your research methods module, you will appreciate the error term and those more technical points. So what we're asking is really this. We can put those technical points to one side to some extent. We have the characteristic line, which we defined last week. And we're just asking, is this alpha positive or negative, or is it not different from zero? And is that varying according to the dividend yield? Right? So that's our point of interest for this topic. So, as I said, we're ranking portfolios according to the dividend yield. Highest dividend yield, second group, which is from 21 to 40% in the ranking, and so on. And then the lowest 20%, and then zero, meaning companies that don't pay dividends, all in one portfolio. So this is confirming what I suggested at the start of this section, which is high dividend yields have higher returns. How do we know that? It's because they've got a positive value in the alpha column. Alpha is the extra return compared to what CAPM would have predicted. And then at the bottom, we have a large negative for the lowest dividend yield. So generally speaking, dividend yield is increasing, although the middle groups are similar to each other. First one is strongly positive, and the last group is strongly negative. So, for example, taking the highest alpha 0.337, that means 0.34% per month. 0.34% per month extra return. So in a year, that's of the order of 3.5% to 4%. So that's extra returns for the companies with higher dividend yields. And then for the zeros, it's negative, but the very interesting thing here is the size of the beta. A very big beta, much bigger than 1. Okay? So the companies that don't pay dividends have got a high beta, meaning high sensitivity to the systematic risk. So again, statistically speaking, A means 1%, so 0.33 is something that's strongly confident is bigger than 0, and here is strongly confident this is less than 0. So the summary there is significant positive returns after the CAPM adjustment for risk. So that means dividend is giving us more return compared to what CAPM predicts. Obviously, the low dividend yields are giving us less return than CAPM predicts. So this is a different angle on the question of pricing, but it suggests that CAPM on its own is not explaining these portfolio returns, and that something about dividends is missing from the CAPM. Or, like we said before, the dividend is highly correlated with the book-to-market ratio. So both of those, dividend yield and book-to-market, may be capturing some other source of risk which is not being captured by the CAPM specification. So dividends is another area where we could find some explanatory power for our expected returns. In terms of the economic significance, if you're interested in investment strategy, this will be labeled as a value strategy. In other words, high dividend paying companies are regarded as value stocks, meaning you get a lot of income relative to price, ID divided by Q. Whereas the contrast would be a growth stock, which is one which is likely to be a younger company which doesn't pay dividends, but you're expecting to get your returns more from the capital gains because it's a growing company, whose assets and sales are going to increase in the future. So here we're expecting much more gain or return from the capital gain, whereas obviously with high dividend yield, you're getting high income portion in your returns. So we close again by the reference list. This is the reference I've been citing on the dividends. And obviously we spoke about Farmer and French newspapers. So again here, it's not the case that this is a reading list. I'm not expecting you to read these. It's more made reference during my discussion to these papers, so I should have a reference list at the end. So we'll see you at 6 o'clock.
So, as you know, we'll be looking at worksheet 4 this evening, and clearly it doesn't relate to today's lecture topic, but rather the previous couple of weeks on topic 3 and topic 4. I'm going to be very careful with these steps. The first question then is presenting information a little bit differently than what you've seen before, because in addition to having the expected return standard deviation in a table, you then have this so-called variance and covariance matrix, and as it's described to you there, the variance is down the leading diagonal, so 0.04, 0.09, 0.16, and then when you take the square root of those, you see the values in the SD standard deviation column, 0.2, 0.3, 0.4, and then on the so-called off the diagonal, we've got covariances, so each of these appear twice. Covariance between A and B, covariance between B and A are the same, and between A and C, as it says beneath the table, 0.008 is appearing twice, A and C and C and A. So, before going any further, any question about that matrix, any problem with that matrix? Okay. So the first task is to identify the correlation coefficients in part A. Just can't see that at the bottom, between each pair. So how many pairs have we got? 3 pairs. Okay, so between A and B, 0.25, yeah? Between A and C, by 1, and B and C, by 1.5. Okay, so using the formula for correlation, using the covariance divided by product of the standard deviations. Okay, so looking at the 3 answers you got, what would you say about those 3 figures? Do they fall in the range that you expect? Yes. So they're between -1 and +1. Yeah. What else would you say about the numbers? They're much lower than 1. Yeah. So they're positive correlations, but they're not very strong positive correlations. 0.25 is the big one. So they're quite weak correlations, but they're positive correlations. So thinking, in reality, that's pretty normal to find those kind of positive correlations between different assets for the reasons we've spoken more about today in topic 5 about why there might be positive correlations, such as the macroeconomic and firm level factors that we spoke about this afternoon in terms of reasons for positive covariance or positive correlation between these different assets. So we're going to use those correlations correlations in part B, where you have to calculate then expected return and standard deviation for different portfolios. So, how many portfolios do we actually have? Is it 9 or is it less? 6, yeah. So there's only really 6 portfolios because number 1 and number 2 and number 6, they have 100% weighting in one of the 3 stocks. And what you notice about the row, what must the row add up to? 1. Okay, so we're investing all the fund in across the 3, A, B, or C. So each row obviously adds up to 1. So number 3, 4, and 5 are 2 asset portfolios, and obviously 7, 8, and 9 are 3 asset portfolios. So they're clearly a bigger calculation they've done in the previous examples. So we didn't calculate variance for the 3 asset portfolio before from this kind of example. We're only looking at 9. How many possibilities might there be? We've got 9 here, but how many would you have to go through if you wanted to look at all the portfolios? If you vary all the weights, how many portfolios would you need to calculate? Not 9, but yes, you've got 6 here. What I'm saying is these are only examples. This is not the whole set of portfolios, is it? That's what I'm saying. So apart from 0.25, 0.75, you could have 0.1 and 0.9, 0.2 and 0.8, 0.3 and 0.7, which we're not calculating. Yeah. So there'll be even hundreds of possibilities just from these 3. So we only picked out 9 here. Yeah. So if you are, looking for an efficient frontier, like we've depicted in topic 4 especially, then it means possibly hundreds or thousands of these calculations would need to be done to find the best portfolios. We've only got 9 here. But at least this is enough for you to see something more detailed about the process. So we've got those 3 asset portfolios. Let me just take you back briefly to topic 3. So here was the equation we had in topic 3 for the 2 asset variance, and used that before. And then here we said, this is from topic 3, we've got 3 assets now in this example. So there will be 3 variance terms and 6 covariance terms. So this is slide number 16 of topic 3. So 3 variance and 6 covariance. So here's 1 variance, pointed to at the bottom here, yeah. 1, 2, 3 variance, and then 2, 4, 6 covariance. Okay, so that relates back to that table that we used there. So those are the means, the methods to calculate the standard deviations. The return is simply the weighted average, as we've said previously a few times. So let's work on the returns first then. Number 1 and number 2, you can read from the table, and number 6, you can read from the table. So expected return number 1, 6, number 2, 8, number 3,
7.5.
7.5, yeah. 4,
7.
5,
6.5.
6.5, number 6 from the table is 12, yeah. Number 7,
10.75.
10.75. Number 8,
8.25.
8.25. Number 9,
7.7.
7.7, 7.675. Yeah. Okay, many people answering those. That's great. So those were just a weighted average using the portfolio weights which are in the table. Standard deviation then. Number 1, 0.2 or 20%. Number 2, 0.3. Number 4. Sorry, I jumped there. Number 3. Let's try number 3. 24%. Yes. Number 4. 20 again. Yeah. Number 5. 18.37. 6 is on the table. 40%. 7. 31.2. Yes. Number 8. 19.3. And finally, number 9. 18.94. Yeah. Okay, so we didn't have quite so many people shouting out the standard deviations. Maybe not surprising, but a lot of people shouting out the expected returns. So let's have a look at the answers together now. So these are the correlation coefficients. So that was part A. And the formula we've got here is seen at least twice or more in your lecture notes. Covariance divided by the product of the standard deviations. And then here are the two columns we've just been discussing. Percentages, I'm noting as the heading, so 0.06, 0.2 and so on. Many of you would have used as your answers. I've presented them in the percentage terms. So, obviously many of you did get those right. If you didn't get them right, we didn't have a chance to complete it, then please do so using these answers as a way to verify your results. Part C is now looking for the efficient set of these. Okay, so the opportunity set is the 9 we've calculated, and then we're looking for the efficient set out of these. So remember, the question would be the efficient set is what is left when we remove which ones. Not by number now, but in principle, what are we using to eliminate from the opportunity set? Dominance. Okay, so we're applying dominance to eliminate choices from this opportunity set, and when we can no longer apply any more dominance rules, we're left with the efficient set. Okay. So which ones are going to be dominated here? Dominated, sorry. Which ones are going to be left out? 1,
2,
2,
3,
3,
4.
4. 5 is not dominated.
6, 7.
No. Not dominated. No. Obviously you can compare them and then returns and risk, but you could also be plotting them. Yeah. So we stop after 4. There's only 4 which are dominated, which is 1, 2, 3, 4. So So the efficient set is there for the others, and it's not because I can't count that I've written 59876. It's 59876 because that's going from left to right effectively. Yeah. So the 1, 2, 3, and 4 are in the bottom right quadrant, as we would call it, the bottom right section, and they're being dominated by number 9 and number 8 in particular. Yeah. Of course, like I said, we've only chosen 9 here. Doesn't mean that those are going to be the best portfolios from these 3 assets, because we haven't looked at all the portfolios from these 3 assets. We've only looked at 9 out of hundreds of possibilities. So these are 1, 2, 3, 4 here in the right hand side, and we would like to be going northwest, north or west, and therefore we've got 5 here, 9, 8, 7, 6. So if you've got a bit of imagination and you join the dots here of these 5, then you can see it's even with only 5, it's starting to look like the shape that we're familiar with of the efficient frontier. Yeah, so we've got these 3 which are offering the lowest risk, but the return is going up as we go 5, 9, 8, and then 7 and 6 are giving significantly higher returns and higher risk. Okay. So this, which is number 8, is dominating this one, and this, and this. So all 4 are being dominated by number 8 there. So if you are being risk averse, that's how you would reduce the set from 9 down to 5. Still haven't chosen one of those. What does it come down to now? We're going to choose from those 5. What would be factor now? Sorry? Not risk aversion, no. We're going to choose in the efficient set. It's only a matter of preference now. Okay. So we already identified the ones in the north and the ones in the west, but now we still have 5 left. To choose among those 5 is still a matter of preference, whether you want to select the lowest risk or whether you want to select the highest return. That's not down to being irrational. If you choose the highest return, highest risk, that's a choice, matter of choice or preference. Okay. Obviously, we don't have a risk-free asset here. Again, that would change the picture if we had a risk-free asset. Any question? Yeah.
I'm still a little confused about risk aversion and preference, because like if you have if you as an investor are risk averse, or if you are a portfolio manager and your investors who are investing are risk averse, obviously that's their preference, and if they prefer high return, that's their preference too. But being risk averse is also a matter of preference. You prefer low return instead of high return, so it's a matter of preference. So why are we using different terms?
Well, the risk aversion was carefully defined, which is to say you'll only take more risk if you get more return. You won't take more risk if you get the same return or if you get less return. So that's how we define risk aversion, and we went through some examples of such comparisons. So here, you know, number 1, 2, 3, or 4 taking those four as a group, if you pick number 8, it's got a higher return and a lower risk than those four. Okay, so on the risk aversion or dominance principle, then, you know, we can take just number 8 and say it dominates numbers 1, 2, 3, and 4. Yeah, and there's other dominants present as well, but that just picks out number 8 dominating those 4. So risk aversion is telling you to delete those 4 because you can get a better return for the same or lower, in this case, lower risk. But risk aversion doesn't tell you then that you must minimize your risk. Okay? Risk aversion doesn't tell you to minimize risk, it's only telling you take more risk. If you get more return, that's your choice then. Yeah. So if you go from number 5 to number 9, you get more return, but a little bit more risk. So there's no dominance. You might say, I get a lot more return on number 9 and only a little bit more risk. But that's not a rule that everybody has to follow. That. You know, that's your choice. Someone wants to minimize risk, that's their decision rule, they go for number 5, it must be. So, yes, you can choose to be risk averse, or you can choose to be neutral, or you can choose to be risk seeking, or any other point of view, but our reference point is to be risk averse, that's our reference point. Otherwise, we could not have had the efficient frontier, we could not have had the CML without risk aversion being an underlying factor or premise. Yeah.
There are just two things, risk and return. So if you prefer, either you prefer lower risk or you prefer higher risk. And like preference, that's your preference. Either you prefer higher risk or you prefer lower risk. So even when you are deleting different portfolios from your choice, and you are left with 2 portfolios, you decide upon whether you prefer higher risk or you prefer lower risk. So basically, it's still risk aversion. That you are risk averse, you wouldn't prefer a high risk portfolio, and if you are not risk averse, you will prefer. So it's still less.
Well, yes, you know, the assumption in our analysis is the investor is risk averse, yes, and therefore deletes number 1, 2, 3, 4. But simply being risk averse doesn't tell us whether they should choose 5, 9, 8, 7, or 6. It's not based on risk aversion alone. So informally, we can say they can use their own decision rule, which might be maximize return, or might be minimize risk, or might be some ratio of return and risk. You know, that's permissible, as it were. It's not central to what we're doing, but that could be used. More formally then, you know, you would say the reason they choose different ones out of these 5 would be about how risk averse they are. So then you're talking about different levels of risk aversion. And, you know, we briefly addressed that with our indifference curves, if you remember. So, you know, how risk averse you are is another way to identify which choice you would make. So there's an informal way you can come to that, or there's a formal way with indifference curves, which not everybody's very happy with indifference curves, I can understand that, but you don't have to think of it using those indifference curves. So we're not trying to make it more difficult than it is, but without those kind of logical steps, we wouldn't get the CML. You know, we wouldn't come to that conclusion. Thanks for your question. Anybody else? Okay, so we move on to number 2 then, which comes from last week, topic 4, because it's referring to beta on CAPM beta. And let's show the question, make sure everyone's got the question. So here we're considering portfolio betas, as the question says, and I did allude to that this afternoon, if I can quickly find this one. So we did mention this afternoon, where we were looking at the arbitrage pricing theory, and we were combining buying and selling this afternoon to generate a portfolio beta of 0 in the arbitrage pricing theory section. And in that case, this afternoon we had a positive X for one asset which we're buying and a negative X for the one we were selling or short selling. So that was the case this afternoon. Obviously it's different in this question we've got here. So what we've got here is 4 stocks, and they're given different betas. Where would those betas come from? Why can't I just show you a table? Where would the betas have come from? Sorry? SML, okay, yes. So you could have estimated them using historical data. So you could have used the SML or characteristic line to have estimated them. You could get them from an information service like London Business School Risk Measurement Service. You can find the beta values. So there are means of obtaining these betas in those ways. Either calculate it yourself from the raw data, or you may be able to access them from financial information provider. So anyway, here we've got the 8 stocks. And what else have we got? Which other beta have we got? The risk-free. And the beta is 0. Risk-free asset. We won't need the interest rate, but the risk-free asset is present and has a beta of 0. So we've then got the question using that formula we had for the portfolio beta. We've got 2 different portfolios in part A, and what's the beta of the portfolio? So first step is you're going to obviously read the beta value from the table. What else do you need? Well, the other thing you need is the XI values. Okay, so you're going to sum across the assets which are in the portfolio, and the beta you simply read it off the table, but the XI you have to calculate. So how are we going to calculate the XI? Take portfolio number 1 there, part A. What would you do to calculate that item XI for Atrial, for example? Yeah, the weights. So tell me, how did you get the weights for Atrial?
Well, out of 2,000, and then Atrial is 30%, for example.
Average.
No. What's the total? Somebody else have. What's the total?
Average.
2,000. Okay, so what's the weight of Atrial then? 300 over 2,000. Thank you. Okay, so you find what's the total amount invested in the portfolio, and then the weight is that stock divided by the total. So obviously you're on the right lines. So 300 over 2,000 for A trill, and that would be multiplied then by beta 0.1. And then you add the next one, so that would be 650 over 2,000 times minus 0.2, and so on. All right with that? So weighted sum, effectively. So what is the answer then for number 1?
0.69.
0.69, that's right. And for number 2?
0.414.
0.414. Yeah. Okay, very good. And then comment on how the stocks influence the beta of the portfolio. Well, in doing the calculation, you've answered that essentially, but if the question asks you to comment, you need to make sure you do comment. And this happens a lot in exam questions, I must say, that a student will do the calculation, possibly entirely correct, and then there's something there like this one, comment, and that's not done. Okay, so obviously there's going to be marks lost there for, you know, simple reason, not finishing off the question. Yeah. So you might consider that the calculation is the time-consuming bit, but if it asks you comment on how they influence the portfolio beta, then if you leave it out, you don't do that, you lose some marks, of course. So the answer would be simply it's a weighted sum. In other words, a high beta asset is going to increase the portfolio beta, all else being equal. A negative beta asset, what's that going to do to the portfolio beta? Reduce it, reduce the beta of the portfolio. If you've got a negative beta asset like Cornet in this case. But otherwise, it depends on, you know, the fraction of the investment. In other words, a proportion of the fund which is put into the asset. Okay, so, you know, such a question is just reinforcing, if it was an exam question, for example, you know, it's just a check whether the student has just learned the formula or do they actually understand what the formula does. Yeah. So, you know, to get the full marks here, you need to be able to say, even if it's only 1 or 2 sentences, what is that formula that you use doing? You know, what's the outcome, or how does that formula operate, as it were? You know, obviously this is specifically asking about constituent stocks. So you see that very often, of course, in the past papers. Maybe most of the marks are for a calculation, but then you do need to say, you know, what you interpret from that calculation as well. So moving on to part B. So now the investor takes a viewpoint. So anticipates a sharp rise in the stock market in the next few months. So would such an investor be hedging or speculating or arbitraging? Speculating, definitely speculating. If you, as an investor, taking a view, what will happen in that way, a sharp rise in the stock market, it's not hedging because you're not protecting risk in this question. It's not arbitrage because it's only one situation, not 2 situations of the consideration. So it's speculation, therefore they could be wrong. Obviously they could be wrong, and the market won't necessarily go up. Okay, nevertheless, if it's that situation, which ones would they like to buy? Sorry? Not? Yeah. Anything else? Pike, yeah. And Jordan, yeah. So what's in common between those 3? Highest betas, yeah. So if you have a strong view like that, you think the market's going to rise, you will look to the more sensitive assets. So if the market, if this speculator is correct, and let's say the market goes up 10%, what would we expect the increase for not to be? 16%, yeah. So it's magnifying any movement in the market. Higher beta greater than 1 is magnifying, if you like, the market movement. So if you strongly believe the market is going up, like in this case here, if it goes up by 10%, NOT would be expected to rise by 16%, 1.6 greater, 1.6 times greater. And which ones would you want to sell in particular then? Cornet in particular, yeah. So if the market goes up by 10%, what do we expect to happen to Cornet? On 20? Sorry? Decreased by 2%. Decreased by 2%. Minus 0.2 times the 10% that we anticipate. Okay? Or anticipate if that was the outcome. If the outcome was plus 10% rise in the market, we would expect from the data Cornet would be falling by 2%. Okay. Well, finally then, for part C, we have an investor who wants to meet two objectives. So for whatever reason, we don't need to think about the reason for their objective, but they have an objective that they want to hold only one company stock, Pike. Pike has got a beta of 1.2, yet they want to have a portfolio with the same beta as the market. So what is the beta of the market? 1. So they say they would like a portfolio with beta of 1, but they only want to hold one stock, and that stock Pike has got beta of 1.2. So how can they overcome that? Using a risk-free asset, that's right. So using a risk-free asset, you can manage the beta value, or you can not manipulate, but you can create a portfolio beta to be what you want. Because the risk-free rate is 0, that can be used very easily to produce a portfolio beta according to your objective. So how much in the risk-free asset?
83% in the Pike is the Pike, and the rest in the free asset.
That's right. So with 83% of the fund in Pike and 17% in risk-free, you would have a portfolio beta of 1. So just recapping those answers for part A, and then in part B, as we discussed, there's 3 stocks with beta greater than 1 that we would want to buy. And then here, this is how we would deduce that we would put 17% in the risk-free asset. So it's the same equation again, the portfolio beta. So this investor said they only want Pike, and Pike is 1.2. And the way they can reach their objective, this is their objective, portfolio beta equals 1 here. And while the risk-free asset is 0, so X% in Pike and 1 minus X% in the risk-free asset. Okay? So in general, that could be applied to other situations, and indeed, that's effectively what I was suggesting this afternoon. So we still use that formula there for part C, and desktop keeps moving around. So the other case which is relevant here is this one that we looked at this afternoon. So here, the objective was different. In question 2C, the objective was achieve beta of 1. This afternoon, here, we had the objective of a portfolio with beta equals 0. Yeah. So, similar, that we have a set objective for the portfolio beta. Here, it was 0 we want to achieve. But it's still the same principle. We're combining two assets, and clearly here we were long or buying B, so we have a positive weight or positive X for this one, whereas we were short or selling or short selling A, and therefore this would have a negative weight. So short position will have a negative weight because you have a short position, you get a positive return when the price falls. Okay. So it's inverted in that sense. So here your problem would be, let's say beta is 0.6 of B and beta of A is 1.2. How do you put them together to get a beta of 0? Okay. So you can do that in a very similar way that we've used here. So difference would be, our target would be not 1 but 0, and if we say this is 1.2 for A, but it would be minus, the X would be a minus then, and this would be 0.6, as I was just suggesting on here. If we take this to be 0.6 and we take this to be 1.2, for example. Okay, so there's a connection to this afternoon's discussion of our desire here to arbitrage, and a risk-free arbitrage would mean finding this portfolio plotting on the y-axis. Okay, any queries about question 2 then? Good job you're here.
And a question about part B, that are we making an efficient market assumption in that, because like we are selecting all the betas which have a value greater than the market value of 1, because in real world it doesn't work like that. Even when we're speculating that the market will go up, it might not be like that. So isn't it better that we should hold some securities that have a beta of less than 1, along with even though we are speculating that the market is about to go up?
Yes, part B is obviously looking at a speculator. So that's why I asked the question at the beginning, what type of investor do we think this is? You know, so we didn't make any other assumptions about whether they're risk averse or anything. We just said this is a speculator. So that gives us freedom to say, well, they will be looking for the maximum opportunity. Yeah. So we could put other constraints into part B about risk aversion or anything else that would make it more realistic. But the objective in part B is just to understand what beta more than 1 would imply, what negative beta would imply. So that's the main thing we were targeting in question B. But you're right, you know, clearly you could manage that risk by having portfolios, but you would dampen down the returns then, obviously. Yeah. In that case, if they're right, or if they're absolutely certain they're going to be right, the thing to do is go high beta.
I would still be at risk, my money would still be at stake, and I would still risk losing money if anything goes wrong, even if there's 0.1% probability in that. So wouldn't it still be better to hold at least one security that has a bit of that?
Yeah, I mean, it depends on the strength of the conviction. Yeah, you know, do you want to go all out? You know, which sometimes someone like a hedge fund does. You know, or more commonly, you're right. More commonly, it would be some kind of more moderate approach to that view the market will go up. Yeah. You know, nobody knows the future. Certainly, phrase here, a few months. Anything can happen in a day, you know, a few months. So, you know, you're right to think about it in those terms, but the question was quite narrowly focused. Okay, so for next Tuesday, topic 6 notes are on Blackboard. These answers will be on Blackboard by tomorrow morning. And then this time next week will be worksheet 5. Okay? If you have any questions before you leave,